Luc, enchanté. Marcelo, enchanté.
Bienvenue à l'Omnium financier 2016. Avant de débuter, pouvez-vous confirmer que vous êtes l'équipe G?
Oui.
Je vous rappelle que vous avez un maximum de 20 minutes pour vous présenter, suivi d'une période de questions de 5 minutes. J'afficherai le temps restant à l'aide de carton indicateur à 10 minutes, 5 minutes, 2 minutes, 30 secondes et les 10 dernières secondes sur mes doigts. Je partirai le chronomètre lorsque vous commencerez. Vous pouvez débuter quand vous êtes prêt.
Just before you start, I'd like to ask you, do you mind if we ask some of our questions in French at the end and you can answer in English, or
Oh yeah, that's good.
that's okay with you?
Yes.
I guess in question period we'll talk, we'll see, we'll try to
Yeah,
translate.
if you- Okay.
Taxes. Personally, I'm not a big fan. But then again, who is? Taxes are usually the biggest expenses for both corporations and individuals. However, with efficient tax planning, these amounts can be reduced drastically. Good afternoon. These are my colleagues Marcello and Lucy. My name is Amin. We are All-Star Consulting. Today, we are here to address your concerns on how to deal with your father's terminal tax return. We will also address the concerns on how you, Martine, the wife, and Jian should deal with the succession of your father's estate. We will give our recommendations, we will look at other considerations, and end off with our conclusions. So, before we go into more details, let's stop here and look at where we stand today. Jacques Peltier, your father and your wife, passed away on January 16, 2016. He also had a company named Construct 2. Currently, there's an offer to purchase Construct 2 from one of the key employees, Serge. But Jacques and his will indicated that he wanted you, Jian, to take over his business, and he's giving you the possibility to do that. So, now, let's look at how the assets will be separated. So in terms of you, Jian, he's going to give you the cottage, the Quebec saving plan bonds that he owns, and 1/3 of the RRSP. Maxime, he decided that he has left you with the life insurance policy, 1/3 of the RRSP, the principal residence, the car, the preferred shares of Jones Limited, the Plicure common shares, and the woodland that he owns in Estrie. So now, my colleague Lucy will go into more details as to how to deal with your father's terminal tax return.
So, right now, we saw that Monsieur Jacques, he passed away on January 15. And because he passed away, he has to file a terminal return, so a T1 that he has to file. And usually, because he's doing a partnership, he can file the return on June 15. But if he has any tax payable, he needs to make the payment before April 31st. April 30. There's also, upon death by ITA 70, there is a disposition of all asset at fair market value. But because in his will, he decided to transfer some of the assets to his wife, there will be a spousal rollover as per ITA 73.2. And depending on the amount, some of them, if we wanted to have a deemed disposition right now, he can have the option to elect out of this rollover if he doesn't want to transfer it at AC. So what we did first was to calculate the taxable income of Mr. Jacques. So first, you have your 3A income. In this category, there's the business income. There's rental income that he received from his rental property. There's also, it's mentioned that he received, the dividends was declared, but since it was not paid yet, those dividends are not included in his income yet. Also, there's 3B capital gains. So those are for the rental cottage. There's a deemed disposition. There's Mr. Jones' capital gains that of the shares we elected out of the 73.2. There's also the Plicure common shares that we elected out. The reason that we elected out is for him to take advantage of his lifetime capital gain deduction right now. So this will go over later by my colleague if the company qualifies or not for the capital gain deduction. After this, we have the 3C other income or other inclusion. So here, For the RRSP, how it works is that usually upon death, there is a deemed disposition of the RRSP at fair market value, so everything has to be included in his income. But there's also the possibility to roll over like an amount of the RRSP to the spousal RRSP if he has one. So this, we only roll over 1/3 is included because that's the portion that he wanted to allocate to you, the daughter. So here's how we calculate it, and your taxable income for on the last return is this amount. After that, Monsieur Jacques will have tax payable. So how the tax payable works? Well, depending on his taxable income, it will be the 15% bracket, 22%, 26%, and the rest will be taxed at 29%. So these are the multiple brackets, and the total, there's the federal tax payable, and since he has a personal amount, he can claim it, and the total tax payable upon that will be $79,000. There's also other consideration concerning his assets. So first for RRSP, so that's how upon that there's the rollover, and then there's the disposition of 1/3 of the portion. Also for the rental cottage, so rental cottage, there will be a deemed disposition upon that because he's not transferring the asset to his, to the wife, it's only transferring to the daughter, so it will be a deemed disposition. The Quebec saving bonds, there is no other implications since the fair market value equal the cost. Also for the funeral expenses, you ask, so Madame Martin, you ask if those there's a treatment for those funeral expense. Because they are personal expenses, they are not deductible against taxable income. But you can use Monsieur Pétier's funds to pay for the expenses. Also, just another quick, as for the rental income, there's also the 4% that you can deduct upon the UCC of the rental property. The UCC was not given, but notice that it is 4% FCC that you can take. For the dividends, so the dividends, they were declared but not paid, but if, how you include, because they are non-eligible dividend, there will be a gross up of 18%, and then the person who is received the dividends will have a dividend tax credit of 13 this amount. And then the car because we wanted to sell it, but because the car it's a personal use property, so all losses are denied upon sale. For the preferred shares, so we'll see if there's a possibility of lifetime capital deduction, we can take that. And for the donations, so we saw the Monsieur Pétier made donations of $2,000, but since and we saw that you kept all the receipts and everything, that is good, but we saw that the company is not, it's not a Canadian charitable register, therefore it won't be allowed. But notice that if it was, the percentage, you will receive a credit of 15% on the first $200 that you made, and 29% for the excess amount. And also, if you are a first-time donor, so there is a super donor credit of 25% for the first $1,000, and this is an additional amount. And other considerations, so we'll see later if the shares are eligible for lifetime capital gain deduction. There's also the land and SG. So someone made you an offer at $37,000, but the fair market value that we see right now on the balance sheet is $47,000. So if you choose to sell it now, you will have a capital loss. Capital loss, usually they are only deductible against capital gain, and they can be carried forward 3 years and carried back 3 years and carried forward indefinitely. But we also suggest that if you could wait for another offer, because right now the fair market value is actually higher than the offer they made to you. So now my colleague, Amin, will talk about what are the implications for succession to you, Martin.
Thank you, Lucy. So Martin, you mentioned to us that you received shares and you inherited shares from Clipio Limited, and that you're not really interested in keeping the shares. So in order to relieve tax burden from citizens, the Canada Revenue Agency has put in certain criteria that enable people to earn capital gains on shares tax-free. And this is if the business qualifies for a qualified small business corporation. And let's look at that now. So the qualified small business corporation, there's 4 criteria that have to be held in order for an individual to claim the lifetime capital gains deduction. And these criteria are noted in Income Tax Section 110.6, subsection 1. The first criteria is that it's a Canadian-controlled private corporation, which PPO Limited is. Then, no unrelated party should have owned the shares in the last 24 months. In this case, it's been your father who owned it, so therefore, it's been your husband who owned it, so therefore there's no problem here. This criteria is met. And the last 2 criteria, in the last 24 months, at least 50% of the assets have to be used to earn have to be used to earn active business income. And the last one is at the time of the sale of the shares, at least 90% of the fair market value of the assets have to be used to earn active business income. You mentioned to us that all these criteria are met, therefore, on the sale of these shares, you, Martin, would be eligible for the lifetime capital gains deduction, and you can earn a certain proportion of your capital gains tax-free, as my colleague Lucy mentioned earlier. So now, my colleague Marcello will talk more into the situation for Jeanne.
Thanks, David. So, Jeanne, you had concerns. You wanted to take aside some of the money that you earned from the trust, from your father, and you wanted to take the rental property, the cottage in Florida, put it in this trust, and possibly have the rental income from this trust be given to your daughter, 3-year-old daughter Camille, so that she could potentially in the future go to higher education, and you want to make sure that she has enough funds in this account to pay her books and tuition. So there are 2 options. Option 1 is create a trust. This is a discretionary trust. This is the trust that you, Jeanne, have mentioned to us. Basically, put Thomas, your father-in-law, into as a trustee who will administer the assets within this trust. Now, Thomas, he wants to have control of who gets this income and when it is distributed to your daughter Camille, or if it might not even be distributed to Camille. He has the control to decide who are the beneficiaries of this trust. So this option, you do not have complete control and complete guarantee that the funds will end up for your daughter's education in the future. As life happens, you never know what's going to happen, and he may one day decide to distribute these funds elsewhere. So it's important to note that that's it. So option 2 is create a trust and contribute to RSP in the name of your daughter Camille, and have a provision in this trust so that the beneficiaries change when she turns 18 to avoid any kind of income attribution. So the interviewer's trust, you have to remember, the first description, first option, where it's a discretionary trust where Thomas is the trustee and he has control. There's a 21-year deemed distribution rule you have to keep in mind. So after 21 years, you have to sell the assets fair market value and reacquire the assets, therefore triggering lots of capital gains and taxable income. As such, it's important to note that the income will be attributed since Camille is under the age of 18. What does this mean? That income from the trust, if she is a beneficiary under the age of 18, will be attributed back to the person who put the property in the trust, which is you, Jeanne. So you'll be taxed on this income, and your daughter Camille will receive this income. Option 2 is the option that we recommend. This is individual trust, and you contribute to RSP up to the age of until Camille is 18. So put a provision. The beneficiary of the trust is yourself up to the age of 18. You receive the money. You put it into our ESP and save this money and make sure that Camille is the one that this money is allocated towards her education and the funds are not used elsewhere. Once she turns 18, make sure that the beneficiaries of the trust will now be Camille, as there will be no attribution to children who are above 18 years and older. So as such, all the income that you receive from this cottage will be guaranteed to go to your daughter Camille and will go to her education fund. You also mentioned, Jeanne, that you had a lot of, just a side note, you had a lot of taxable income and little loans with interest expenses. The only interest that you may deduct is interest from your student loans. And it is important to also note that the RESP contributions are not deductible. Basically, it's after tax, and not like our RSPs where you deduct it off your full income. These are after tax dollars that are going towards there. And it was drawn, and as it was drawn, they're taxed in the hands of Camille once she's actually a student and she's actually taken out money to pay her tuition and books and her education expenses. Now it's important, we will talk to you about other considerations. So, there is an offer from Sage for this partnership. This is another issue that we're addressing that we're not sure, we'll suggest a couple of options of how to deal, if you should either keep Martin, if you should either continue to run your father's business and become a partner, or if you should sell your shares to Serge, which is an employee who has been working for your father for many, many years and who wants to be his right-hand man, who wants to take over the business. So option 1 from Serge is a one-time payment of $550,000. Option 2 is basically he'll pay you for the first 3 years, he'll pay you 10% of the average of the yearly revenues. And on the 5th year, he will give you a lump sum of $500,000. Now it's important to note that the average revenue over the past 5 years is $500,000. However, they're expected to decrease by 10% in year 1, and then incrementally increase by 2% every year, so on and so forth. So we are basically expecting, the expected payment is 10%, and the sale of the first years. So next slide we'll show you the calculations of our present value calculations and the estimated capital gain. So present value option 1 is $500,000. After discounting, the total proceeds of this addition is $561,104. And as an option 2 is the option we recommend, as it offers a higher proceeds of disposition, including discounting. It is important to note that these are our estimated ACV, so our estimated capital gains on your total amount would be $95,000 per year. Okay, thank you very much. So, other considerations. I will now pass you on to Lucy, and she will talk to you about the car expenses.
So we saw that for your the construction goes through the company has some expenses and some treatments about few items. So first, it's Tom's car. So Tom's car, because it's the company who is leasing a car and providing to the employee, there will be taxable benefit that he has to include in his income. So first, there's the standby charge. The standby charge, how you calculate it, because it's a rental car, so it will be 2/3 of times the rental amount and times 12 months. Also, there's the operating cost of 27 cents per personal kilometer traveled. So we saw that Tom was using principally for 60% and more was used for business purposes, but usually he will be allowed for a reduced charge. But in this case, because actually the number of kilometers personal travel was too high, so there's no really a deduction that happened. Also, for the company can deduct all the maintenance, gas, and repair costs. But the lease payment, it was $1,500 per month, but the company can only deduct $800 per month for the lease payment. Now, for the private plan, so we saw that there were multiple travel trips that were that was made, and how we treat those expenses is that if the business portion, all those expenses are 100% deductible for the company, but the personal portion of expense, such as going to the fishing trips, those expenses are not deductible because they're considered personal. Also, for the convention, how it works is that we saw that the company had 10 conventions per year, but by the rule is that for 1 year, there's only 2 conventions that's allowed where you can deduct all the expenses. So in this case, usually if there's only for 2 conventions, 100% of the expenses are deductible, and for the meals, it's only 50% that's deductible. Finally, for investment losses. So investment losses, how we saw that Sam and Tom, there was some investment loss. And how it works is that the total amount of losses will be allocated to Sam and Tom personally, depending on their partnership their interest in the partnership. In this case, it wasn't indicated, but depending on the percentage, you will allocate the amount of loss as how you allocate salary. So, and those capital losses, they can be carried back for 3 years and be carried forward indefinitely. So in conclusion, today we addressed how the concern concerning the tax consequences upon the debt of Monsieur Petit. We also saw where the concerns for you, Martin and Jean, of how to treat the succession, how to put in place the trust, and what are the consequences. And if there's any you want to know more about the capital gain or the calculations, how it worked depending on the option, we'll be happy to go over the Q&A period for more details. So thank you very much for choosing All-Star Consulting. And we'll now open for questions.
Okay, so can you go back to a slide where we can see the income for Jacques? I just want to ask you, you talk about the rollover, the possible rollover to the spouse.
Yeah.
But I can see here that you included the capital gain for John's Ltd shares.
Yes, in this case, there is a rollover, but we can elect out of the rollover. Why we're doing that is because we're trying to use up the lifetime capital deduction from Monsieur Petit, because so that she can use the rest of her capital gains, she can save it for later. So that's what.
Okay, so you create revenue, but you don't necessarily pay taxes on this because of the
Lifetime capital gain. So what we can see is that you would include it, you will include in your 3B income, but it will be deducted in to calculate the taxable income.
Okay. Okay.
Toujours dans la déclaration de Jacques, par rapport à Constructif,
Oui.
à sa participation dans la société en nom collectif, est-ce qu'il va y avoir un impact dans la déclaration au décès là-dessus?
Sa participation, en fait, dépendamment de la partie de revenus qui sont gagnés durant l'année, on doit alloquer une partie dans son...
Ça pour la quote-part du bénéfice, ça,
Oui, c'est ça.
je comprends par rapport à sa participation dans la société.
Est-ce qu'il est réputé en disposer, autrement dit, à son décès ou
à son décès, oui, il est réputé à disposer.
C'est quoi les conséquences de ça?
Les conséquences, ça devrait être une disposition à valeur juste marchande, puis il y aura des conséquences de gain au capital si la valeur juste marchande est plus haut que son PVR au départ.
For the investment losses, you told us that they are all allocated to Sam and Tam. Since they were in the past, wouldn't a part of it be attributed to Jacques too, or?
I see.
Yes, a part of it, yes, this is a partnership. Depending on his controlling interest, this is more information that we would need as exactly how much he owns and exactly how much, let's say, withdrawals and how much income he actually made that year. If he made capital losses, for example, if he owned 20%, then 20% of those losses will be Jacques' losses, and he'll be able to use that against his income.
And if it's the case, you would use it against the income for this year?
Yes, you could use it against any kind of income. It's business income, it's non-capital income, and therefore you can use it against any kind of income, basically.
Okay.
vous avez calculé les impôts à peu près à 80 000 $. Est-ce que vous avez suffisamment de liquidité pour acquitter ces impôts-là?
En fait, c'est ça, on avait regardé, il y a quand même un gros montant d'impôts, principalement dû, on a le mortgage qu'on va payer, puis on a vu, il y a aussi les dettes, les dépenses pour les funérailles. Donc, ce qu'on a pensé, quand on a regardé vos assets, vos personal assets, ce qu'il y avait, par exemple, il y avait le land, que ça, vous pouvez considérer, en fait, on peut le vendre, puis ça peut donner une grande partie assez de liquidité. Sinon, il y a aussi, dans le pire des cas, on peut toujours prendre des RRSP, parce que ça aussi, vous avez environ 300 000 de liquidité. Donc,
Okay, I don't know if we have enough time, but for the trust, I just want to make sure I understand your strategy. It's a trust that you create.
Yes, so the strategy is basically it's a trust that you create to make sure that the income you receive from the rental property that Jeanne you received from your father, you would like to put this in the trust, and then the income, you take it out and you save it and it'll be given to Camille as for her education in the future.
But the trust is in Jean's name. Is that correct?
The trust, yes, the second option which you recommended, the trust is in Jean's name. We put in place a provision, so it's a non-discretionary trust, and these terms will not be changed over time. And basically, until Camille's 18 years old, the beneficiary is Jeanne. You receive the income, and with that income, you contribute to Camille's RESPs, or Registered Education Savings Plan. As soon as she does turn 18, then you change the beneficiary. You have provision as soon as you open the trust that on Camille's 18th birthday, she will now be the new beneficiary of this trust, and she will receive the income from this trust instead directly, which she could use for her books and her tuition and education.
La période de question était